Welcome back to the Compound Journey, everyone. The account is officially funded, and that means it's time to talk about why I chose SCHD as my first investment. Now, my goal for this portfolio is to build long-term wealth through dividends, and SCHD gives me a solid starting point to do that. And in this video, I'm going to talk about what SCHD is, how it's different from other popular ETFs like QQQ and VOO, and my strategy going forward to build a portfolio that pays massive dividends. Let's start with what SCHD actually is. SCHD is an exchange-traded fund, or ETF. Now, what's an ETF? An ETF is simply a basket of different stocks that you can buy with one investment. It allows you to effectively own small stakes in many companies without having to purchase every stock individually. And since ETFs trade on the stock exchange, they're as easy to buy and sell as regular stocks. So what makes SCHD so special that I would choose it to begin my investment journey with? SCHD is a Schwab U.S. Dividend Equity ETF, and it holds 100 large U.S. companies all selected under specific criteria. What is that criteria? Well, to even be considered for inclusion in SCHD, a company must have paid dividends consistently for at least 10 years. From there, SCHD scores those companies based on several financial ratios and selects the top 100 companies with the highest score. This process is repeated every year, with companies being added or removed based on their scores, creating a portfolio of strong dividend payers with reliable dividend growth. Take Home Depot, for example. It currently makes up about 4% of SCHD. It's a company most of us know, the home improvement giant, and over the past 10 years, it has delivered a compounded annual dividend growth rate of 14.5%. Home Depot, along with the other companies inside SCHD, helps the ETF deliver a current dividend yield of around 3.8% and a 10-year annual compounded dividend growth rate of about 10%. With its low expense ratio, strong current dividend yield, and double-digit dividend growth over the past 10 years, I believe SCHD is a great pick for me to begin my investing journey. Now, what makes SCHD different from other popular ETFs like QQQ or VOO? Well, in today's market, which is dominated by tech-heavy names like Microsoft, Google, and NVIDIA, companies that make up large portions of QQQ, and even VOO, which tracks the S&P 500 and whose returns have been heavily driven by these same tech names. I like that SCHD gives me balance away from the technology sector. Instead, it's more focused on sectors like energy, consumer staples, industrials, and healthcare. Now, that's not to say that QQQ and VOO are bad ETFs. In fact, it's quite the opposite. They're great ETFs. And I actually hold both of those ETFs in other investment vehicles. My goal for this portfolio is to build wealth through compounding dividends. And at the end of this journey, I'd like to have a portfolio that pays massive dividends every month. And in my opinion, SCHD is a little better in helping me accomplish that goal. Now, here's the plan going forward to build a portfolio that pays massive dividends. Early on, the most important part is accumulating capital, which is why every single extra dollar I have will be invested in SCHD. And eventually, once I start getting to a bigger portfolio size, maybe around $10,000, I'll start layering in individual stocks around SCHD. Stocks that have a history of long-term dividend growth. However, my plan is to ensure SCHD always remains a staple in the portfolio. The foundation everything else is built on. So that's it. We made our first contribution, chose our first investment, and outlined the long-term strategy. Here's the official M1 Finance account, which I've named the Dividend Portfolio. Now let's see where this journey takes us. Be sure to subscribe so you don't miss the Compound Journey.